All right. Welcome, everybody. We're going to take just a few moments here and let our stragglers arrive. If you're on the call and you got our webinar link, you're here for the Prism Perspectives. Could I retire today webinar? If you weren't here for that webinar, you're flying to a different city, then you might have to depart the plane and head back into the terminal.
I remember doing that. I'm going to an airport.
The good old days. All right, I am gonna get us started here, and we'll let those stragglers trickle in and catch up as they can. So I'm Tyler Heyman, CEO of Prism Financial Concepts. Thank you for joining us today. Our discussion is, could I retire today? And like all know, Prism works at the intersection of business owners, business and personal financial life. We work for business owners and entrepreneurs, professionals who retire. And when they retire, they generally have a fair amount of questions about how to utilize the resources to support their retirement needs. And so we've got a crack team who's got a lot of experience in dealing with addressing that question, addressing how you structure your investments to support it, and how financial planning plays a role in the process of ensuring that you don't run out of money. And Bill Luhrs in a few minutes is going to talk to that topic. Before that, I'm going to go through my normal market update that we have been conducting almost weekly over the last 5 weeks. And we will begin with kind of an update on where we were last week when we spoke, which was the title or theme was Stimulus Unknowns. And at the time, we had seen the first round of PPP and EDIL stimulus come into the market, but we didn't know then, and we still don't know today, what the impact of that stimulus is going to be or might be in the marketplace. How many businesses will it save? If it doesn't save all the businesses, what is going to happen with those companies? Will there be bankruptcies? And how will those bankruptcies impact the economy at large? And then ultimately, how will that flow into the stock market, real estate markets, et cetera? Prior to that, our theme was holding our breath. We weren't sure where we were in the peak case count curve or the peak death rate curve for coronavirus, and we were, holding our breath in anticipation of when we might reach that point and what sort of stimulus the government might throw at the challenges that businesses were facing as a result of the quarantining. And this week, our theme is stock market enthusiasm, or stocks market enthusiasm. We've got a market that's gotten pretty excited, and within the confines of this very fast bear market, we now have already seen a pretty big bull market rally. And so the big question is this bull market rally just in the context, is it a reaction inside of this larger bear market that could play out over many months? Or is it something that's really the beginning of a larger uptrend in stocks? So we've shown this chart over the last several weeks, and we estimated that on 3/30, this is about where we were in the case count curve, and where we needed to be in the, or where we thought we might be in the GDP curve, not necessarily an exact overlaid time, but just kind of where we were in the stages of the process to protect GDP. And the 330 number right here in blue is illustrating that we, it gotten a little closer to peak case count. We felt we were suppressing the virus a little bit more. There was a little bit of expanded treatment. And then by 420, we felt that we were closer to the peak, if not a little bit over. And I think the numbers of the last week continue to reinforce that we may have headed over the peak in peak case count. And while we aren't necessarily decelerating in total cases at a great clip, we're at least seeing a little bit of deceleration in overall cases and the death rate, which is obviously enormously positive on many fronts, not least of which is, is the economy and most definitely is the human life component. So this week, we haven't seen significant improvements from last week, but we're seeing improvements nonetheless. So I haven't modified this this chart much. Jobless claims. We are to an estimated 26 million jobless claims. We're again kind of hoping that this number will turn around very quickly. And while this is an astronomical number in a short period of time, there's a real chance that if states broadly reopen next week and into May and June, that this number could go down fairly significantly and fairly quickly. What the ultimate low end of it will be by the end of the summer is still too difficult to tell, but we're going to be paying very close attention to this number in the coming weeks. So we've attempted to overlay the stock market return profile on our peak case count graph, and thus far this is kind of what it's looked like. We've seen a pretty nice return from stocks, and we have yet to see a new low materialize, down here at the previous low for the S&P 500. Although different indices have performed different from one another. For instance, the small cap stock market is not even above its 50% retracement mark. In other words, it hasn't even retraced half of the losses it had since February when it peaked. But the NASDAQ index is actually closer to 75% retracement of its full decline from February. And part of the reason for that is the 5 stocks that make up 20% of the S&P 500, Amazon and Facebook, Google, etc., are large tech names that are carrying both the S&P and the NASDAQ index. Other indices that are performing well are healthcare and biotech. And those couple of index segments by themselves tend to be carrying these markets higher, but at the expense of other indices that would oftentimes show that we're really in an improving trend and a new bear market is starting. So in the absence of seeing smaller company stocks and the broader market participate in this rally, I'm feeling like there's a chance we could, and I'm getting the sense from my technical analysis that the markets are still at risk of seeing some additional declines and in need of some firming up before they start to head higher again. And of course, it's impossible to know if that's going to be the case, because there's now well over $2 trillion in stimulus that's been provided in a number of different forms and fashions to the market. We could reach $4 trillion or even $6 trillion or more dollars in stimulus. And so the counterbalance to the concern about bankruptcy and the concern about the duration of people going unemployed is this amount of stimulus that's in the market that could help a number of stocks that by themselves could continue to raise the broad stock market. So it's a really challenging time if you are trying to time the market, but the numbers, the underlying breadth of the market suggests that there's still some risk. So last week's chart, we saw this sort of peak decline of 34% that rebounded and kind of headed up into this 50-day moving average resistance point for the S&P 500, which again was a little over a 50% retracement in the fastest bear market, followed up by the fastest bull market in history. And today we've got a slightly different chart. What we're looking at here is a monthly chart of the S&P 500 going back to 2010. And interestingly, in 2010, from then to today, we had about 22 million jobs created, all of which have vanished over that time period. And we see this large sell-off on our chart. Let me see if I can get in here. Large sell-off starting up here at the upper end of what's called the Bollinger Band. And we came all the way down to the lower end, even breaking through it temporarily. We've now rebounded, and this price candle is suggesting that we're back to the midpoint of this Bollinger Band, which represents a point of natural resistance for stock prices. combined with the fact that we had a high volume sell-off point here, this high red candle here is volume of stock prices, or volume of stocks traded. And we can see that the volume was significantly higher than the average over time here. Typically, when we get to the end of a market range and we see this kind of volume of selling, it takes some time before we regain the highs of the prior market period. The only other times we tend to see very high volume periods are in the early stages of a bull market. And so there was a lot of volume back here in 2010 and 11, post the emerging markets debt crisis or during it. And that sort of set the stage for this large run up in stocks. The fact that we have negative MACDs is not great either, and this will likely take some time to work off on these charts. And we're also in a period of what we consider decumulation of purchases here on the relative strength index. So all these things tell me that it's still time to exercise some caution in your stock ownership. It doesn't mean if you're a 10-year investor you don't want to own stocks. It just means if you just sold your business and you've got that $1 million in the bank and you want to put it to work, I would exercise caution before doing so. So with that update, I'm going to turn it over to Marie. And Marie, do you want to check in with everyone and field any questions that we might have had come in, or invite anyone to ask some questions?
Sure. Hi. So just real quickly, for those of you who may be newer to the webinar with us, there is a chat button on your screen, or a Q&A button actually. So if you have questions that you want Bill or Tyler to answer, just simply type them in there for the chat screen and we can broadcast them for you. Bill will be presenting his portion next, and so we'll have another Q&A opportunity at the end of the window. So if anyone has questions specifically for Tyler about this review, feel free to type those in and we'll get those over to him. Outside of that, you're all muted for right now, but you can also click the chat or wave your hand and we can let you join us and ask the question. And the questions we've gotten so far in advance are going to be for Bill, so we'll wait and let him presentation, see if it answers the question. And
okay, thank you, Marie. So we'll do this. I'll turn it over to Bill, and if anybody's kind of trying to articulate a question or think it through, feel free to send it off, and we can always take a pause or towards the end of the presentation, address any of the questions that have come in for me. So with that, I'm going to turn it over to Bill, and the floor is yours.
All right. And let me share my screen. All right, well, hello everybody. So it's just a recap from a presentation we had done a few times before, just a high level. This is our sequence of return risk. And this is showing a sequence of returns coming from the market, -10, -13, -23. If you've been with us before, I did not make those numbers up. That's the actuals from the S&P 500 since 2000. So if you had been an investor at $1 million when you retired age 60, in 2000, and you were drawing 4% out at a time, the 4% rule, and this sequence of it, and you were invested in the S&P 500, you pretty much ran out of money at the age of 77. And so we showed as a couple scenarios or strategies to reduce that. One is controlling what you have most control over, which is your spending. So if in the down years you reduced your spending by 30%, so every time there's a bad year, the following year you reduce your spending, your discretionary spending by 30%, and then go back to your full spending once the market's back up to speed. You can mitigate a large percentage of that loss. The other thing is to set up your portfolio working with your advisor and setting up a portfolio that minimizes your downside but still provides you some up level when the market performs well. And then combining those two strategies together gives you more safety as you head into your retirement years when you're not earning income. So one of the questions we had the week before is how do I retire early? And what I'm going to do is I'm going to show you a real scenario. This is my personal, so I never share clients' information, but I will share mine. And one of the big strategies is if you try to retire early, is to get your expenses down so that what your income streams, primarily your investments, or if you happen to have rental properties and other income flows coming through, you want to provide as little draw off those as possible. And so one of the strategies to do that is clearly to reduce your expenses. And for the vast majority of people, the number one expense is their living expense, whether that be renting or home ownership. So what I'm gonna do is take you through a scenario, and this is real life. This is about 2.5 years ago now. For my wife and I, the kids left, and we decided we wanted to move out of our large home and downsize into a condo. So this was our strategy: sell the house, use the cash to buy a smaller home, buy cash instead of having a mortgage, take the remaining cash and invest it, eliminate our mortgage and principal, lower our property taxes, lower our utilities. It's going to be a smaller place, less maintenance, lock and leave. Well, our frame was like, we want to live carefree like we were in the 20s. So we didn't have to worry about fixing anything, cleaning stuff, or cleaning was super easy. We want to live like we were in our 20s again. Have more money for vacation. And then if we wanted to have, the downside of downsizing is that you may not, if there's a big events, family events, your home may not be large enough for that. But we said, we'll rent a VRBO, and those, every 2 or 3 years, a really large one, have fun with the family. So we'll have all the extra money. So this is pretty much the real numbers for us. Not pretty much, it is the real number. So this is our spending when we were in a 4,700, it was a nice house, 4,700 square foot house. We had a mortgage, our property taxes, home insurance, all the stuff related to, the actual home. And then the utilities, the electric, gas, water, sewage, security, everything to manage it, to run the home. And then we had maintenance and other services like cable, landscaping, pool service, housekeeper, was a large home, and insect control. So we were spending roughly $6,300 a month running that home, or about $75,000 a year. When we move in, we call our condo del Soleil, but it's a 2,600 square foot condo, so it's a nice condo again. But our mortgage is zero, so we decided to pay cash for the house as opposed to taking out another mortgage. Our property taxes are significantly lower. So one of the strategies, if you decide to employ this downsizing type of approach, is when you do look at the new location, pay very close attention to the school district and the size of your lot, because particularly in like Scottsdale, most of the cities, at least in Arizona, those become components of making up your tax bill. So if we're in a condo, we have shared footprint. And then number two is our amenities, the complex we picked doesn't have really large parks ingrained into it. So that extra property ends up getting spread across all the property owners. So I learned a lot. I mean, this condo is about half the price of our original home, and its property taxes drop by 75%. Home insurance drops with the value of the home, size of the home. Pool, yard, repairs, in our house, every time there was a major storm, we had to get a tree replaced or branches, special cleaning, pool repairs, etc. Now the HOA pays for all that. We had some flood insurance. Electric, it's a smaller place, more efficient, so we're about 60% off on that. Our gas has dropped dramatically. Water, sewage has dropped dramatically because of square footage. And security, we do have a security system, but it's an alarm, and we have neighbors near us, so if it went off, they'll wake up and call the cops, so we decided to get rid of that. HOA is the only thing that really went up because we are getting the house painted, roof repaired, landscaping is all done for us. So that did go up proportionally. And then cable and internet stayed the same, of course. And the rest of the stuff, landscaping, pool service, all done, well, except for the housekeeper, that's me. But it's a smaller place, it's pretty easy to take care of. So end result is we went from $6,300 a month to $978, which is about $5,300 a month in savings. In order to make $5,300 a month in rough order of magnitude, every 200,000 creates about, using the 4% rule, creates about $1,000 a month of income, roughly. So that's literally almost equivalent of $1 million worth of investments, the equivalent, in order to support. So we reduced our spending by about $64,000. If I take out the mortgage, so exclude that, okay, as part of the savings, we really said as actual expenses, we saved about $2,500 a month. The other added bonus is we saved about, when we sold it and bought cash, we still had $195,000 worth of home equity after we paid our mortgage off. So we were able to use that and then reinvest it. So that's our scenario that occurred. And it's about almost 2 years ago now. So Let me show you what the impact is over time, and it's significant. So this is just an example we did I think it was a couple of weeks ago, where I moved my cell phone plan from AT&T over to T-Mobile with 6 users. I went from $235 a month down to $190. Doesn't sound like a lot, $45 a month, which turns into $540 a year. But because this type of bill, this service is going to get inflated every year with cost of inflation. So if it's up by 3% per year, that 540 savings eventually in 30 years would be $1,300 a year in savings. And if I invested it instead of giving it to the cell phone company at a 7% rate of return, that little decision on cost reductions turns into $78,000 in 30 years. I had a retiree I worked with just a couple weeks ago. She still had $11 a month Apple iTunes. She got like a free subscription on iTunes for 90 days and then forgot to cancel it. Been running for over 6 months at that point. And that still in 30 years is $20,000 worth of savings. So these little savings you can find turn into big money later on. Same thing's true like when I decided to buy a Honda CR-V instead of an Acura. Instead of spending $49,000, I spent $33,000. Saves me $16,000. That's a one-time, right? So there's no inflation impact on that. But that $16,000 saved and invested turns at 7%, turns into $126,000 in 30 years. So these are kind of smaller ones. When I show you the impact of downsizing, it's incredible. And I'll show you. So if my current monthly spending when I was in the large single-family home was about, excluding the mortgage, was about $3,436 a month. So $3,436. My new cost is $978. So we pretty much can live in this place, HOA, property taxes, insurance, all in for about $978 a month. So that saves us about $29,000 a year. And if you take that out by 30 years, that's $4.3 million. And what I'm doing is I'm going to step back. Each one of these, because these are expenses that property taxes go up every year. Insurance goes up every year. Your HOA, sewage, utilities, they go up every year and they're affected by the rate of inflation. So this $29,000 is going to be in 30 years, $71,000 in today's, in future dollars because of inflation. And if I took that savings and I invested it, it literally compounds into $4.3 million. So it really helps. If you're thinking about retiring early, or if you are in retirement, you still have a large home, or you think you can move into something smaller, it really has a compounding effect that can add. And let me tell you right now, Susie and I, that's my wife's name, we're not going to just save all this money and give it to the kids. No, we're using this so we can travel and have more fun. The other thing that I will look at here is this $195,000 we saved. So, our plan was that we were going to, that $195,000 was going to get consumed, okay, in the home. But the reality is we decided to free it. So that was going to be locked. That $195,000 was locked up, okay, in the equity of our home. So we freed that immediately and went ahead and we did invest it at an average rate of return of 7%. In 30 years, that turns into $1.5 million. So you combine these two together, it's not trivial. It's almost $6 million worth of differential by one move, one decision, and that was for us to downsize. So that's kind of the fun math we like to do at Prism, is try to figure out, what different options do you have if you don't have enough money to live the lifestyle you want as you head into retirements in the future, or if you are in retirement now and how can you make it last longer. You look at lots of different alternatives and then help you do the math to make and allow you to make a better decision, or at least a more informed decision, and understanding what the risk and the reward trade-offs are. So pretty amazing. I mean, $6 million, one decision that we made. And it's made a difference in our lives because life is much more carefree. Unfortunately, we can't use our fun extra discretionary money because we're not allowed to eat out or travel. So it's not working out well.
Best laid plans, right, Bill?
Yeah, it's not working out well in the COVID. Yeah, but our savings, are doing well. So, you go with the flow, and hopefully we'll spend some extra next year and make up for it.
But it is a great point. You have a lot of control over how to minimize your cost pre-retirement to potentially accumulate more assets with less work on behalf of your resources, or post-retirement, where you can make some new decisions about what things are really important to you, what is the life use of your money really all about. And if you hadn't whittled away at that budget in a while, this is a great it's a great way to get some insight about the value and benefit of going through that exercise. So
I mean, a quick math solution I work with folks is, and it's kind of sometimes hard to do, depends on their Social Security situation, but Social Security has a cost of living adjustment. So if you can get so for instance, for us, if I know that $978 a month, or, rough order of magnitude, $12,000 a year, if I add food on top of that, that's going to be about, call it $20,000 a year. So if the worst zombie apocalypse happened, if we can get our living expenses below our Social Security number, and Social Security grows with the cost of living, you're pretty safe. Now, it may not be an enjoyable life, okay? But that's kind of putting into the worst case scenario. How do you get through and retire early is, part of it is solve your expenses for your base expenses, excluding discretionary fund money. And try to get those as close as you can to your guaranteed income flows like Social Security.
Bill, we have a question that someone sent in using the scenario of selling a current home to downsize to a smaller one. If they weren't going to have the excess cash equity like you did from the sale, would it make any sense to not outright buy the new house, maybe make a sizable down payment, but keep a small mortgage?
It depends. Part of it depends on the income streams that they have. So for instance, if you're still working and you're going to be working for another 15 or 20 years, and your job prospects are pretty secure, then yeah, it may make sense to go ahead and use that money because you've got a really large cash, an income stream coming through. So that's, that would say, yeah, I would consider using a mortgage, in that case. Another scenario would be every year you wait after what's called FRA, your full retirement age of Social Security. So, a lot of folks, if you're born after 1960, that's 67 years old. Every year you wait, you get an extra 8% guaranteed by the federal government increase in your Social Security benefit. So if you need some extra money to bridge so you can hold off drawing from 67 and waiting until 70, that's an 8% guarantee on an annuity that in essence is going to grow every year with inflation. It may make sense to take a mortgage out to help bridge your expenses until you hit that 70-year-old point. So there's a lot of different scenarios, but it's a fun one to experiment with, and it depends how much money you need now and frankly the security of the income streams that you have coming in, particularly from work.
Got it. So it's really all in the numbers. It's all about the math.
It's the math and how they interact with one another, and trying to solve for the most optimal scenario you can. And sometimes that doesn't, the optimal way won't work, or the lifestyle cut is too much. So then we figure out what those trade-offs are and come up with at a minimum, a solution that is workable to achieve their life objectives.
I had a slightly different question. Someone who is thinking of retiring early, so they're a little bit younger than they ideally would have been to draw their full retirement. Is it ever worth cashing out the retirement, even though they have to pay a penalty, if they felt strongly enough about the investment options on the account? Whether it's turn around and reinvest it, can you generate enough cash flow that way to warrant pulling your 401k or your IRA out?
I can't even imagine a case, honestly. I mean, of course there are, a family emergency or something, but it'd be very exceptional to take a 10% penalty before 59 and a half. I mean, that's an immediate hit. Plus, on those accounts, excluding a Roth, you have to pay ordinary income tax on top of it. Or even on a Roth, on the gain that you would have. So you're going to get taxed, if you're still making money, and you're in I'll call it the 15% tax bracket, you're going to pay 25%, 25 cents of a dollar when you take that money out. So I would work with the person to try to figure out solutions not to do that. And that would involve either spending, looking at their spending opportunities, and maybe, some lifestyle like a downsize like I just went through. The other opportunities maybe if it's a short-term bridge, it's something called a 72T, where you can withdraw funds out of a qualified account without penalty. You'll still have to pay the ordinary income tax, but there's a lot of rules for that, and kind of it handcuffs you. You know, you have to take it out for at least 5 years. It's something that deserves a lot of analysis. So there's ways to do it. I would really advise against it. Try to do everything you can to avoid it.
And I'd probably mention, Marie, that if you were doing it for the sake of making an investment in something that you didn't have access to inside of the IRA you are currently in, or the 401k you're currently in, there are plenty of alternative custodians that will allow you to hold a real estate C interest, or direct notes, or private placement interest. So more and more these days, owning alternative investments or the direct real estate can be done inside of a retirement account if that was the objective of the investor.
Yeah, and that's smart because you don't pay the 10% penalties. There's some other fees with it, but if it's alternative investment that is got you feel confident with, the fees are a lot less than the 10% penalty.
Yeah, good point. Okay, that's it for the questions that came in today.
Great. All right. Well, thanks everyone for joining us. Bill, thank you so much as always, and hope everyone has a great day and a healthy week. Thanks again.
Bye-bye.